Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CBL and Associates Properties Inc. Annual Report. And CBL and Associates Properties Inc. offers a diverse range of businesses and services through its national portfolio of market-dominant properties. The company's owned and managed portfolio includes 88 properties across 22 states, comprising high-quality enclosed malls, outlet centers, lifestyle retail centers, open-air centers, and other assets. The company's portfolio consists of various types of properties that cater to different consumer needs. These include 55 enclosed malls, which provide a comprehensive shopping experience with a mix of local and national retailers. CBL also owns and manages outlet centers, which offer discounted prices on brand-name products. Additionally, the company operates lifestyle retail centers, which combine shopping with dining and entertainment options. In addition to these traditional retail properties, CBL's portfolio includes open-air centers, which provide an outdoor shopping experience with a mix of local and national retailers. The company also owns other assets, such as freestanding buildings and pad sites, which offer flexible space for tenants to operate their businesses. Overall, CBL and Associates Properties, Inc. provides a wide range of businesses and services through its diverse portfolio of properties, catering to the needs of consumers in dynamic and growing communities across the United States. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase. The stock price of CBL and Associates Properties Inc. has increased in the past year due to several factors. One key reason is the company's efforts to revitalize its portfolio by acquiring new properties and redeveloping existing ones. This strategic move has helped to boost investor confidence, leading to an increase in demand for the company's shares. Another factor contributing to the rise in stock price is the improving retail landscape. As consumers become more comfortable with online shopping, brick-and-mortar stores are adapting by offering unique experiences that cannot be replicated online. CBL and Associates Properties Inc. has been successful in creating such experiences at its properties, attracting a loyal customer base and driving sales growth. Additionally, the company's focus on enhancing the overall shopping experience through renovations and expansions has also contributed to its success. By investing in modern amenities and attractions, CBL and Associates Properties Inc. is able to attract a wider range of customers, including younger demographics who are increasingly seeking out immersive retail experiences. Furthermore, the company's efforts to diversify its revenue streams have also helped to drive growth. By expanding into new areas such as entertainment and dining, CBL and Associates Properties Inc. has been able to reduce its reliance on traditional retail sales and increase its overall profitability. Overall, the combination of strategic portfolio management, a focus on enhancing the shopping experience, and diversified revenue streams has contributed to the increase in stock price for CBL and Associates Properties Inc. over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a business can be attributed to several key factors. On the positive side, acquiring new properties and assets has been a significant driver of revenue growth. Rental revenues have also increased due to higher fixed lease payments and variable lease payments. Additionally, management fees, development fees, leasing fees, and marketing revenues have contributed to revenue growth in some years. However, there are also several drivers that contribute to revenue decline. Losses on impairment of assets and losses on extinguishing debt have been major contributors to revenue decline. Concessions and other adjustments have also reduced revenue in some years. Furthermore, changes in tenant mix, capital requirements, and economic risks such as interest rate fluctuations and market conditions have impacted revenue growth or decline. In conclusion, the primary drivers of revenue growth or decline are complex and multifaceted, involving various factors that can either positively or negatively impact a business's revenue. Understanding these drivers is crucial for businesses to make informed decisions and develop strategies to mitigate risks and capitalize on opportunities. The net income of the company underwent significant fluctuations between 2022 and 2025. Initially, it increased by a substantial 17% from $3,204 in 2022 to $57,117 in 2023. This growth continued into 2024, with an increase of 132% from $57,764,000 to $133,878,000 in 2025. However, the net income decreased by 136% from $57,117 in 2024 to $134,526 in 2025. The profit margins also experienced changes due to various factors. They increased due to gains from dispositions in 2024 and 2025, but decreased significantly between 2024 and 2025 due to a large increase in net income compared to a relatively small increase in revenue. The reasons for these changes can be attributed to both internal growth strategies, such as contractual rent increases and new tenant acquisition, and external factors like inflation increasing operating expenses, decreased occupancy rates, increased energy costs, and international trade disputes impacting tenant operations and demand for real estate. The fluctuations in net income and profit margins were influenced by a combination of internal and external factors. While the company's growth strategies contributed to its success, external factors such as inflation, decreased occupancy rates, and international trade disputes had a negative impact on its financial performance. The company's financial performance indicates a consistent generation of positive operating cash flow. According to various summaries, net cash provided by operating activities has been steadily increasing, with a notable figure of $249,680 recorded for the year ended December 31, 2025. This trend is further supported by the operating cash flow status being labeled as positive on multiple occasions. The company's ability to generate positive operating cash flow in both 2024 and 2025 suggests a stable financial position, indicating that the business is capable of covering its operational expenses and generating excess funds. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the total debt increased by 32% from $2,255,020 to $2,981,239 between two unspecified periods. However, in a later period, the total debt decreased by $69,902,000. The consolidated debt also saw an increase of $38,478 from not provided for 2024 to $1,251,158. Additionally, a secured term loan was partially paid down by $46,000, and new loans were assumed totaling $519,647. In terms of interest expenses, there has been a notable increase. Between two unspecified periods, the interest expenses rose from $54,207 to $193,627, representing a 257% increase. Furthermore, in another period, the interest expense increased by $21.5 million. However, in one instance, there was a decrease of -8.3% in interest expense change. The variable rate debt service also saw an increase of 34.5%. Overall, while there are some fluctuations, the general trend suggests that both debt level and interest expenses have increased significantly over time. Management is emphasizing the company's focus on long-term value creation through growth in net operating income, NOI, and free cash flow. To achieve this, they are implementing internal strategies such as rent increases, tenant mix improvement, and operating expense control. Additionally, they plan to densify assets by adding non-retail users to drive traffic and sales. The company is also committed to active portfolio management, identifying underperforming assets and redeploying resources to maximize value. Furthermore, they aim to balance their debt by reducing it, extending the maturity schedule, and limiting floating rate debt and recourse loans. In terms of capital allocation, management plans to repurchase up to $25 million of common stock, capitalize on property values through joint ventures or sales, and pursue opportunities for non-retail uses such as hotels, offices, and multifamily developments. They also intend to guarantee debt of joint ventures to provide funding at a lower cost. The company has adequate liquidity to meet its cash needs, with sufficient funds generated from operations combined with cash on hand and investments in U.S. Treasury securities. Management is confident that they can generate additional liquidity through various options such as joint venture investments, financing of unencumbered properties, or reducing capital expenditures related to tenant construction allowances. However, management notes that the company's ability to use tax attributes to offset future taxable income may be limited due to past ownership changes. Additionally, the expiration of the 2021 recognition period on November 1, 2026, may lead to a greater portion of distributions being treated as non-taxable returns of capital. Nevertheless, property operating cash flows are expected to provide sufficient funding for capital expenditures. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has invested in 3 major shopping centers: Cool Springs Galleria, Oak Park Mall, and West County Center. These investments were made as joint ventures, with the company holding a 50% interest in each property. On the other hand, the company has also divested several properties to streamline its portfolio. The Layton Hills Mall, along with its associated outparcels, convenience center and plaza, have been sold off. These divestitures are likely aimed at reducing the company's financial obligations and focusing on more profitable ventures. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid common stock dividends ranging from $0.40 to $0.45 per share, with an occasional special dividend of $0.80 per share. This demonstrates a commitment to returning value to shareholders. In addition to dividend payments, the company has also engaged in share buybacks. Over a specific period, the company purchased 482,142 shares, with a total value of $17,671 in October, $16,257 in November, and $14,293 in December. This strategic move not only reduces the number of outstanding shares, but also boosts earnings per share for existing shareholders. The maximum amount authorized for share repurchase was set at $25 million, indicating a significant commitment to this strategy. Supply chain disruptions pose a threat. The extracted summaries reveal potential concerns regarding supply chain disruptions that could impact various aspects of business operations. According to page 7, adverse economic conditions may lead to increased operating costs due to supply chain disruptions. Furthermore, international trade disputes and tariffs, page 11, could weaken demand for real estate, increase redevelopment project costs, and delay the delivery of key inventories and supplies. The potential consequences of supply chain disruptions are far-reaching, as highlighted on page 19. Temporary or long-term disruptions in tenants' supply chains may lead to delays in inventory delivery, complete or partial closure of manufacturing facilities or distribution centers, and reduced sales due to supply chain disruptions. These concerns underscore the importance of mitigating risks associated with supply chain disruptions to ensure business continuity. That concludes the financial summary for CBL and Associates Properties Inc. Feel free to comment below, and I will be happy to answer them when possible.